Okay, we're recording also now. So this is again a continuation of our discussion about mutual funds, and the purpose of the mutual funds. Again, we said what is it? It is a pool of investments which are within a portfolio, and you have a portfolio manager, and that portfolio manager, he or she will select the types of securities to put within the mutual fund, right? So we talked already about the types of investment products, how they are traded. We talked about also the modern mutual fund, right? And we also talked about overall basic concepts about mutual funds. So today we're going to talk in more detail about the types of mutual funds, right? So that is the purpose. Mainly, we're going to go through chapter 11 and 12 next. Okay, so I'm gonna, so as you can see here, of course, when you go, so you can see my screen, right? See my screen?
Yeah.
Yes. So I just Googled Scotiabank. So just go there and you go under Scotiabank website. This is the public website. Or any other, if you like RBC, you can go RBC, you can go to TD, any other company you want to, Scotiabank, any banks, go to their website. And there you can see the different, of course, they have everything else, also line of credit and investments and insurance, but we are focusing on investments. And investments, as you can see, so see, first of all, I want to show you again here the plans. So under investments, the first thing is you have to talk about what are your goals, right? So when you're talking to clients, this is the part of the, when you talk about ethical standards and getting to know the client, you have to ask them what is the purpose of your investment, right? If they want to protect their retirement income, or do they want to reduce their borrowing costs, or do they want to save a big purchase, save for a down payment for a house, saving for education, saving for retirement. So you first talk about what are their goals. Based on the goals, then you open up the appropriate plan. By plan, they mean accounts, the proper accounts. So either disability saving plan, education saving plan, RSP, and tax-free savings account or RIF account. So these are your registered accounts, right? And there's also, they didn't show, but there is also a non-registered account you can open up also, right? So the plans, you would open up the appropriate account, and then you talk to them about the options they have. In Scotiabank, they have mainly in the branches, they have guaranteed investment certificates, which are like a bond. So they work, so GICs are, they work exactly like the bonds we talked about. Are you guys familiar with GICs? Do you guys know?
Yeah.
Yes, you know about GIC. Harvey, are you okay with
Yeah.
GICs?
Yeah. GICs. Yeah.
Yeah. And so the GICs, they are basically just like bonds. You put in your money, $10,000, you get 3%, 2%, and they're locked in for 5 years or 3 years or whatever years it is. And that's it, right? Savings account, obviously opened up, you get a little bit interest, right? And we are focusing on the mutual funds in this course. And ETFs also are going to be discussed about a little bit in this chapter. In the alternate managed products, there we'll talk about ETFs a little more. So when we go to the mutual funds, there, we will talk about what are the different types of funds, right? So under funds overview, so we can go here. And here we can see that overall there are different classes of mutual funds, right? So these are the categories similar to what is in your book. Okay, in your book, the conservative mutual fund products are the first ones, and those are the ones which are here under cash equivalent. So what is the cash equivalent? It's just like cash. It's just like money in the bank, right? So they provide safety of principal and interest income. So of course, anybody who does not want to lose money, anybody who does not want to get other income, they just want interest income a little bit, and they want safety of principal, they will be investing in this type of cash equivalent fund. And it is conservative because it is safe. Okay. So in here in your book, you also in your course, you have money market fund. So I'm going to go through the money market fund here with you guys. Who is this good for? So this is good if you want interest income and liquidity. So what do we mean by liquidity? Anybody want to tell me what is the meaning of liquidity?
Cash.
You can just empty it.
Yeah, you can take as liquid. It means it's like water, right? So yes, that's right. You can easily take your money out if you need to, right? So That is right. And so this is for income and liquidity, and primarily through short-term fixed income securities. If you remember, we talked a little bit about money market. Money market are less than 1 year, usually the 3 months, 6 months. They are, very short-term, right? So they are going to be having that objective there, right? And you don't want to lose money, so that's who it's for. So the objectives are they are going to be invested in federal, provincial, and municipal government and chartered banks securities. All right. Now, as you can see, the price here is $10. So $10. This is, you see, now today is Wednesday, right? And it's May 26th. We don't have the price yet for Wednesday. The market just closed around 5 o'clock. Right now, the fund accountants, they calculate the price, and you will know the price next day, later on, maybe tonight or in the morning, you'll know what the price is. So it's usually calculated on a daily basis. So we'll talk about the returns later on, but I first want you to let's look at the fund profile. So when you sell this to the client, you have to give them the fund profile, and you should understand all the features, what is requirement in the fund facts, and this is all in your book also. We will talk about later under the regulations and everything. This is important to also to provide to the client, right? So in the money market fund, Series A, so this is, of course, and this is also late. It's not the latest one. I mean, it's April 30th. It's now May 20th. So they are, way behind. They should have updated. Well, April to now, they'll update the May 30th. It's usually monthly they update this. But you can see the actual information online. So what does it have? The fund facts is just a 2-page document. We said it's maximum 2-page front and back. The investment objective is given here for this type of mutual fund to provide, as we said, income and liquidity, high level of safety, and this is again the objective we just said. And as you can see, the risk rating is here also. Risk rating is for the client, it's low risk. Low risk means there's very little chance that you will lose your money. Okay, so it is low risk. We will look at the other ones, which are medium and high and very high risk ones. Okay, so what it is, so here we can see what it's invested in. It is invested in, these are money market securities. Okay, as you can see, July 23rd, 2021, this is just maturing in a month or two. This is a money market fund, which is giving 1.67%. Royal Bank security, this is also a money market fund. It is also just maturing in next month, in 2 months, July 15. And this is, so all these are short-term investments, as we can see, all maturing almost now. This is only next year. And majority of the investment are just short-term money market funds. And the City of Toronto 6.8 is getting pretty high interest, but that's only 2.5% of the assets. So as these come mature, what happens when this is going to come mature? The portfolio manager has to find and invest in other securities, other money market funds, right? So as we can see here, it is 95% just in cash. There are no bonds in this. There are no stocks in this investment. There's nothing fancy in this. It's just securities, money market securities. This is showing the performance if you had invested $10,000 in 1990, which is, a long time ago, it would now be worth about 20,000. You would have doubled your money in so many years, right? So it's not a lot, like at 40 years, that's nothing. It's peanuts, right? And so it's, as you can see, there's 0 stock holdings, there's 13 bonds, and there's 34 other holdings, which means other investments. Like this is the mainly, so they call it bonds, but they are money market, small short-term bonds, which are less than a year, which are money market funds. Let's look at the performance. So we said that the returns are not very great. You see here, they don't have years here, but we can see that it was very early 20,000, hasn't gone up much. We can see here from the returns. So these are the returns are provided here. 10 years, 0.47, 5 years, 0.6, 0.7, 0.5. And as you can see, yearly returns also 0.35, 0.3. So how do you feel about these returns?
Pretty shit.
Yes, they're very low, right? They're
Mhm.
not even beating inflation. What is inflation in Canada?
2%.
2%. So if you invest in here, you hardly don't even beat inflation, right?
So the money market is just a safer way for people to invest their money in if they want zero risk at all.
Yes, that's right. Like many companies also have a lot of cash lying around. They don't want to put it into risky investment. They have, millions of dollars in their bank account. They'll just put it in money market, just get a little bit. It's just like, hardly peanuts, hardly anything, right? So, and as we can see here, this fund was started out in 1990. $207 million is invested in it. You can start out with $500 in this one, and you could put $25 a month also. Okay, so this is giving you overall what you can invest in it. We will talk about the yield later on, the calculation, but the yield again, remember, you'll see the yield all over the place, everywhere. Yield is basically return, and return 7-day yield is 0.1%. So that means that you're getting 0.1% hardly. So this is a calculation. We'll do that later on. I want to do the calculation later on. Just get an idea. What is yield again? What is your return on investment, right? And it means if you put in $100, you only make like 10 cents, which is nothing, right? So MER is your management expense ratio. Every mutual fund has an MER. The MER is 0.59 for this one, right? That means that you're paying 59 cents per year. This is annual per year on your investment. So actually this return here has the MER minus from it already. So in 1 year, if it made 0.10, actually it was lower. It actually made less than that even. It made, so they already minus this from it. So 0.59, it actually made 0.69, and they minus this from it, and you're left with 0.1. So these returns all have the MER minus from it already. Is that clear? Does that make sense? It's not like you get 0.1 and then minus 0.59. It's not like that.
So the MER is the percentage that they take back for the portfolio manager?
Not the portfolio manager, but the company. Yes, the company will. This is the way they make money, of course, right? So
okay, yeah,
the mutual fund company will, yes, they will minus the MER from your annual return, and this reported return has the MER minus from it. So this is the annual amount. So the 1 year, I'm looking at this one, like 1 year, it made 0.1%, right? But it actually made 0.69%. And they minus the 0.59, and they report it made 0.10. That's what you as an investor is going to get in your account, right?
So the MER gets distributed between the the holdings in that money market.
What do you mean holdings? I don't understand.
Like it goes to the MER gets divided into like everyone, like everything that's in that money market fund.
What do you mean divided? I don't understand what you mean by divided.
Because like the MER, right? So it's not like the investor is getting the MER back. The MER is going back to the company.
The MER is your fee. It is as an investor, you are paying 0.59% of your investment. Okay, can you calculate if you put in $10,000? Can you calculate what is 0.59% of 10,000?
We get to get my calculator.
Yes, anybody want to calculate what is 0.59% of $10,000?
0.59%. It's only $59.
$59. So in 1 year, you're going to pay $59 for the mutual fund.
Okay.
But actually, so what are you going to see in your account for $10,000? You're going to see $10 increase. That's 0.10.
0.10.
Okay, that's $10 out of $10,000, right? You're going to see $10 increase in your value on your account. They minus the $59 from your account. So you're not going to see the 59. They're not going to take out $69 and then put it back. And then like it's going to be, you will see only this amount in your account. That's it.
They already take that percentage before putting it in your account. So you don't.
Yes, that's right. That's right. Yes, exactly. Okay, clear? So that is, so we'll look at the other ones also, NAV, and then Benchmark is, we will discuss later on, performance. The returns of this fund is compared with a benchmark. It is a combination of different investments. Here we're looking at FTSE, TMX, Canada 60-day T-bill index. It's an index that we monitor the returns, whether it did a good return or didn't do a good return. We will talk in more detail about this load, but load means when you buy and sell the mutual fund, there may be a fee. All the bank mutual funds are usually no load, meaning when you buy the mutual fund or you sell the mutual fund, you do not pay any fee. Okay, so that is usually in the case of the bank mutual funds. But if you buy a mutual fund from a investment advisor, you may pay a fee to buy or you may pay a fee to sell. But MER still is going to be there. MER, all the funds have MERs. Okay. So this, of course, is showing you the portfolio managers. So this is Bill Gerard is the portfolio manager. He is working with this company. So Scotiabank actually has, this is the fund manager. Scotiabank's fund manager is 1832 Asset Management. This is the company which is managing the mutual funds for them. And the company has hired Bill as the portfolio manager. Okay. And here you want to know what is Bill's background. This is Bill, the portfolio manager. He's been in business since 1994. He's managing this, and he basically has a lot of experience, MBA, smart guy, CFA, and this and that. So this is about the portfolio manager. Okay, clear? So that was just about the money market, the first one. So next, let's talk about the we talked about the money, and the other ones are similar, T-bills and all the same ones. So that is one category. The next category we need to talk about are the income funds. Under the income fund in your book, you have got bond fund and you have mortgage fund. So I'm just going to show you one of those each. Okay. So we're going to look at the bond fund. So what is the bond fund invested in? Obviously, from the name, it's going to be invested in bonds, right? And we talked about bonds yesterday, how they work, right? So here again, it's showing you the price for yesterday, $10.27 for one of the fund units. And so let's take a look at the fund facts a little bit better, see everything there. So under the fund facts, we can see here that this is to provide a steady flow of income and modest capital gain. So remember, capital gain is possible because bonds you can buy lower and you can sell them at a higher price. Remember the bond prices we talked about, bond may go up and down, right? The price may increase. It may be at a premium, it may be at a discount. So you could get capital gain from a bond, but you will also get interest because the interest will come from the bond. So this is again, it's invested mainly in Canadian fixed income securities. And as we can see, the risk is now a little bit higher than that was very low risk, the money market fund. This one here, $100 million invested in it. And the MER now, as you can see, a little is more. It's not 0.59, it's 1.30. Okay. And the benchmark is different also for this one. It's a universe bond index. So here you can see what are the investments. It is invested in bonds, which are issued by Canada government bond, province of Ontario, province of British Columbia, Quebec. So mainly government bonds, as we can see.
Sorry,
yes.
sorry, I have a question. What
Yes.
is benchmark, like index?
Yes, the benchmark index is, I will show you, like TSX is a benchmark for the equities. If we want to see, has a stock done good or bad? So when we talk about performance, one is to compare the mutual fund with a similar mutual fund. That's one way you can look at the return. Another way is to look at what is the return of this fund compared to the benchmark. And the benchmark should have similar composition like your investments. So this Canada Universe Bond Index has similar types of investments in it. And if this goes up and down, if this, for example, went up, ours is expected to go up. If this goes down, ours is expected to go down. So this is our reference index. Does that make sense? Is that
Yeah.
clear?
Yeah.
Okay, good.
Thanks.
So here we're saying that this is all in Canada, and as we can see, government bonds, 63% of the bonds are issued by the government of Canada. So that is why it is low risk. But there are also 26% company corporate issued bonds, and no stocks in this one. There are bonds in it. 57 of them are bonds. And now we look at the returns. Now you can see here, last 1 year, actually it lost money. As we can see here, this dip here going down, it is showing you that in the last 1 year, the bond fund actually lost money. So that's why there's no guarantee. There's no guarantee even in the money market funds. But the year before is 1.66, 2.84, 1.68, and 10-year is 2.84. So as we can see overall, it has varied. So the difference between compound returns and calendar year return. Compound return says if you invested in this fund 3 years ago, your money would now be up 2.84%. If you invested 5 years ago, this is how much it would have gone up. And the calendar year returns shows us each year. It means from January 1 of 2016 to December 31st, if you sold your mutual fund, you would have got this amount, 0.49%. Okay. And again, these returns have the MER minus from it. So 1.3% they already minused. This means this already has the 1.3% minus from it. So even if the fund goes down, they will still minus the MER. The mutual fund company is still going to get their money. And basically you would have lost the value of your investment in it. Tough luck, right? Clear? Okay. So hold on for blood distribution. We'll talk about that later, but to understand this is still a conservative type of mutual fund. You're going to look at the equity one. So here, as you can see, if you put in $10,000, it went up to 12,000, then it dipped down, and then it went up, and then it dipped down, and then it went up. So it's going to be a little bit like a roller coaster. Here you're going up again to 14,000, and then 15,000, but now it went down again to 14,000. So it's going to be going up and down a little bit in your account. That's why it is low to medium risk. Yes, any question on this? Clear? Okay, so that was under the, again, income fund. The other income fund you have in your course is the mortgage fund. Let's take a look at the mortgage fund. From the name, obviously, it means it is invested in mortgages. And mortgages are obviously being issued by Scotiabank, right? So Scotiabank has this fund. If you put your money in the mortgage fund, your money will be used to pay out the mortgages to investors in for the mortgagees, right? So the main purpose is to provide regular interest income and invest in high quality mortgages on residential properties in Canada. And so it is invested in, obviously in Scotiabank mortgages through Scotia Mortgage Corporation. Okay, and they're giving security that if they default, the Scotiabank will cover it up. So it is a low risk option there, because mortgages are insured also, some of them through CMHC or Genworth, and otherwise there will be high ratio mortgages. So those are safer ones, and so these mortgages are covered there. That is why, again, this is low to medium risk. Okay, and there's $220 million here, minimum 500. So MER is 1.47 in this. Okay, and the NAV is 10.66. So that is the price. Now here again, the benchmark is different. For each of them, the benchmark depends on what type of investment it is, right? So the here we can see there's not going to be a lot of big up-down jumps like the other ones we saw, like the bond fund. This is relatively stable because it is in mortgages, and you're getting, like, if you put in 10,000, it has been going up, but the returns, if you look at them, 1.7, 1.27 every year, 1.62, 1.7, hardly beating inflation. So how do you guys feel about this investment? What do you think? How would you feel about it?
Too long.
Huh?
Too long to get your money back.
Yes. So it's a more long-term investment. It's just stable.
It's a long-term investment, but it's a secured investment though.
Yes, right. Okay. And so in this way, we can see that overall, it's mainly in fixed income, of course, in Canada, and mortgage-backed securities. These will talk maybe a little later in the alternative mutual funds chapter, in chapter number 13. We'll talk a little bit about these mortgage-backed securities. So if you think about it, a mortgage is really an investment. If you think about it opposite, um, the bank has $100 million or $220 million to give out in mortgages. They will give out the money to the home buyers. They buy a home. As you know, the homes are secured by Scotiabank. They put their name on the title. And so if the mortgages go bankrupt, if the person who's paying the mortgage goes bankrupt, they get title to the house, right? And the mortgagee, the person who has the house, they're going to pay interest to the bank, right? They're paying their monthly payments, they're paying their principal down, and they're paying interest to Scotiabank. So that interest income that is coming in is actually like an investment. And so that it's not just one, it's going to be a lot of, millions of dollars of interest being paid every month. And the investors are going to get some of that interest here back. So this is the interest you see here. That interest is actually coming from the interest payments from the mortgages, right? In the bond, it's coming from the interest payment from the bond. Here, it's coming from the interest payments from the mortgages. Does that make sense?
Mm-hmm.
Right? So this is how the mortgage one will work. And here also we can see that we have two managers here, and they have a lot of experience, 20 years experience, and he's over, a lot of experience, also highly qualified portfolio managers. Okay, clear? Any question on the mortgage fund?
Pretty clear.
Okay, good. All right. So let's go on. In your conservative one, they have also a dividend fund as a conservative type of investment. So we're going to take a look at the dividend fund. This is the Canadian dividend fund, and they put it in the conservative because it is. See, okay, remember, if you recall from yesterday, dividend are only issued by corporations, by companies who have stocks for the public, right? So the this will give you the okay. So yes. Okay, so the dividends are issued by the corporations from their stocks, and it is safe because if you have preferred, see, this is here saying it is invested in preferred shares. As you recall, we talked about it yesterday. These are types of shares which will pay a fixed dividend. Okay, so let's take a look at the fund profile. So now here we have, as you can see, medium risk, a little bit more risky, and it is invested in high quality dividend paying companies located in Canada, right? So that is the purpose of this. And yes, here we have got, now you can see a lot of more investment here, $6,300 million. That's $6.3 billion has been invested in this fund, in the dividend fund. So that's a lot of money. And here the MER is 1.74. And for one unit, if you want to buy one unit, it's $76 for one unit, right? So in this way, you can see that it is a very highly, it has a very high price also, but it's worth it. As you can see here, if you put in $10,000 in this 1992, it would have gone up up to 50,000 here in the mid, and then it would have gone up. It would be worth about $100,000 now since 1992, right? In the money market, we saw hardly it would be worth 20,000, double your money. Here, money would have gone up 10 times. But of course, it would have dipped down here if you sold here and left it. Then tough luck, you lost on this. Here also went down. This was the drop probably in the market last year, went down, and then again it's gone back up since then. So this has investments in Canadian company shares, 59% of it, and 29% is in US company shares. All right. And the performance, as you can see, 1 year, 22%, 6.94, 9%, 8%. So overall, it's been over long term, it's doing pretty good, but still no guarantee. As you can see, 2008, it did go down 4%. 2015 hardly made anything. Okay, 2011 minus 4.78. So if you hold it for 1 year, that's why we say mutual funds are not good for short-term investment. Short-term meaning not less than 3 years. That's why, because you see in 3 years, you would have made still 9% if you kept it for 3 years, 3 years ago. We don't know the future also. Year to date, it's been doing pretty good. This is till April 30th. It's done 8%, but last year was not good because of Corona. Obviously, the market went down, and this one also went down, and it did go up before by December, but it still wasn't back up where it was. So 2020, Corona affected it because it affected all the company's shares, as you probably know. As you can see here, it is invested in stocks of Toronto TD Bank, Royal Bank, Scotiabank, Energy Company, Brookfield Asset Management, National Bank, Enbridge, Microsoft, Pacific Railway, and CIBC. So large companies, of course, well-known financial companies, 30%, energy 12%, industrial 10%. So we can see that sector allocation, and we can see that most of the companies, 89% are mega companies. Mega means over $34 billion market cap. We didn't talk about market capitalization yet. This is market capitalization depends on what is the price of the shares and how many people buy the shares. That is what the market cap is. Okay. And so in this investment, you would have, so it is of course better than the other, but it's still also more risky. There's no guarantee. Again, if you sell this to a client, you cannot guarantee anything. You cannot promise anything for the future. We can only show past performance, and we can say that we have a reasonable expectation this trend will continue in the future, but we have no surety, no guarantee. Okay, so that is the performance here that we have to tell them. And it is, as we saw, 49 of them are stock in holdings, and they are mainly invested in those. And here we have the portfolio manager, different ones. So there are 3 different portfolio managers. Because it's so much money, probably they need more people to manage, decide, or some like Bill is probably going to be, someone may be more focused on US companies, they know about those. Some may be focused on Canadian companies. They usually divide up their responsibilities or something like that. So this is this is the example of the dividend fund. Is that clear? Any question on that?
So dividend is just a mix of different kind of holding, a mix of different stocks in that holding in dividend funds, right?
Yes, it is invested into different types of stocks which are issued by companies. Yes, you're right. And the main, let me also bring up the textbook. I'm going to just bring up the textbook. So yes, it is invested in different types of investments, which include your also, and the dividend funds. So remember, there are 2 types of stocks. What are the 2 types of stocks? You remember? Preferred is one, and what was the other one? Anybody? Anybody did their homework? Yes, me.
Is it common?
Yes, perfect. Common share and preferred shares. Yes. So this dividend fund is mainly invested in the preferred shares. The preferred shares, because preferred shares are going to be giving dividends. Okay. And so we are going to get dividend income from it, and it is safer than the common shares. Okay. Here, right? So yes, so that is the purpose of the, and so again, it will depend on how much dividend you get, and depends on the price shares, how much they go up or down, right? And based on that, then you will get your return on it. Does that make sense? Is that clear? Right?
So it depends on how much it goes up. That's depending on how much it goes up. That's
Yes.
will depend on how much you'll get paid out.
Yes, that's right. Yes, exactly.
That's what dividend fund. Okay.
Yes. Okay, so let's take a look at the textbook. Let me share my screen here, and you can see. Okay, sorry. Here, let me share this here. Yeah, this way I should do it. Tony, let me share my screen. Okay, so you see my screen, the Modern Mutual Fund, 10, go to chapter 11. So here in your chapter, see, this is what we talked about already. I just want to show you. So we talked about the money market funds, okay, investment objectives. We talked about overall money market. You know, they don't do a lot of returns. They're showing like here, very low returns. And with the performance data, I'm going to talk about the calculation of the yield later on. I have like after a few, after next day or so, we'll start doing the calculations for the yield also. But for now, hold on that. We will do current yield also and yield to maturity and this yield, all three. We'll do that later on. In the money market in your book, they talked about overall, give me an example. I showed you the example. And then we talked about mortgage mutual funds, right? And we talked about also what are the different, how they get the returns, right? And then we talked about also other fixed, so there's other ones, the bond funds, we talked about that. And then we talked about here, they're showing a typical bond fund is going to be a little bit in money market, mainly government bonds, provincial bonds, and corporate bonds, right? And then we talked about the risks of it and the overall, and then the dividend fund. So the dividend fund is going to be invested in preferred shares mainly, right? So they are the ones who preferred dividend funds. They call them preferred dividend funds because they are invested in preferred shares. And but there's a risk, like I said, there's no guarantee. And so that's it. So that was the first, that was the chapter number 11, your conservative mutual funds. In the riskier ones, we're going to talk about equity, balanced, global, and specialty. So these ones we're going to talk about next. Okay, equity, balanced, global, and specialty. Let's take a look at those. So in our dividend fund, we are going to close that. Let's go back to Scotiabank site. And you can see here under the equity funds, there's a wide range of equity funds. Okay, Canadian obviously are mainly invested in Canada. US obviously invested in US. Okay, let's take a look at one of the, the Canadian equity fund. Let's take a look at that. So this is again invested in the, where's the, okay, so this is invested in Canadian companies, right? And these are all in mainly in Canada, large companies with growth potential, right? So this is invested in there. It is again medium risk. It is not going to be low risk because it is invested in Canadian shares, 75% of Canadian shares, US equity. Here the performance you can see 6 months 25%, 1 year 30%, 10.32. So can you calculate if you put in $10,000, how much money will you make in 1 year? Yes, anybody want to tell me based on 30.3%? If you put in $10,000, how much would have gone up by?
3,000.
3,000? Sorry, how much did you say? Yes.
Yeah, 3,000.
$3,030. Yes,
Yeah,
that's right.
3,030. Yeah.
Yes. So in your account, you would have $13,300, right? So this shows you obviously that is how you estimate how much it would have. But this is 1 year ago. If you had invested 1 year ago, this is how much it would have gone up. There's no guarantee for future, but it shows you past history. Overall, 8, 9, 10%. Even if it's 10%, it means if you have $10,000, it means it went up by $1,000, right? So, but you can see every year, it means that from January 1 to December 31st, if you had put it in 2018, it would have gone down. As you can see here, the roller coaster from 10,000, it would have been gone up and down, 40,000, then down to maybe 30,000, then up 35, then, so it would have been going up and down like that. And here last couple 6 months, it's gone up a lot. That's 25%, it's gone up. And overall, this is the, so US Canadian equity, 75%. As we can see here, Royal Bank, Scotiabank, TD, Onyx, Power Corporation, Shaw, this is Rogers Communication, Intact, Enbridge, Boardwalk REIT. We'll talk about an alternate investments. This is a real estate investment trust, which is invested in real estate companies. Montreal, Bank of Montreal, also BMO. So these are all stocks. As you can see, all of them are stocks, 47, all of them. There's no bonds in this one, and there's and they are the, this is the investment. And again, of course, here you see now MER is higher. Usually for the equity funds, the MER is going to be higher. But are you, instead of, if you're going to look at the cheapest one, are you going to just go, I want to buy the money market one that's the lowest? MER is just like 0.59%. I don't want to buy this one, but the return here is higher, right? So you should not look at only MER, right? This one, 2%, so what big deal? If you're giving 2% and you're making 30%, it actually made 32.3%, and you're giving 2% to them, so it's okay, right? Is that clear about MER?
Yeah, as long as the return rate is good, then MER really doesn't matter.
Yeah, doesn't matter, right? So yeah, the MER, and of course it's more, the MER is charged based on their expense. So the company has to spend money for buying and selling shares. It's more expensive. They have to do research. If they want to invest in any company, they have to do research on the company. They have to sometimes even they go out and visit the company because they're investing millions of dollars in it. So they will have a lot of meetings and reviews and this and that costs money. So they charge more MER usually for equity funds. Okay, so the equity fund is all going to be invested in stocks and other types of investments.
I have a quick question.
Yes.
The NAV, like when you're buying the stock, the price. So if I'm buying it today, does it stay like that? Do you buy it on today's price, or do you have to like wait till tomorrow to find out the price?
Yes, good question. So the price, yes, so the price of the mutual funds is calculated daily. So here you see, okay, and that it showed different price today. The price it's showing yesterday was 37.05. Okay, today now the market is closed. If you were to go to a branch that is open, suppose till 8 o'clock, and you place an order now, you will not get this price. You will get the price which is calculated, not even the Wednesday price. You will get it, tomorrow is Thursday. Thursday at 5 p.m., whatever the price is calculated, that is the price you will get tomorrow. Because the trade will go in tomorrow when the market opens, and they will process the trade. The calculation will be done at the day end. So you will get the price for the next valuation day. That is the rule in mutual funds.
So if I got it today at like 12 o'clock, I would get today's price, correct?
Yes, but at 12 o'clock, you won't know what the price is today till the market closes.
Oh, so you don't know what the price is till it closes?
No.
4 or 5. Okay.
But you see, this is okay. If you look at how much variation, it's just going to be a few cents usually, or maybe very little change. It's not going to be a huge change usually. It could be a little higher, it could be a little lower. In one day, the price will not fluctuate a lot, but you won't get exactly this price. Okay, if you bought it on Friday at the close, you will get the Monday price, Monday close, and Monday at 5 p.m. That price you will get. They only calculate the price at the end of the day, and you will get the closing price for the next valuation day. That's why you cannot. So one of the unethical things you will read about in the regulation is you cannot promise a future price. You cannot say to the client you will get $37.05 per share. You can only say this was the closing price on the previous day, and you will get the price based on the calculation at the end of business day today.
And is there a uniform close day, or is it different for everyone?
So it's every business day. At the end of the day, they will do the calculation, the fund accountants, So like today, they would have been still working on whatever the price is. It will be updated tonight on Wednesday. And then every day, so every business day, if there's a holiday, like Monday was a holiday, so they will not calculate on that day. It will be the next valuation day if it's a long weekend. Okay, is that clear? If you want to see more detail, you can see it here under the prices. I can show you that also here. The funds overview, the learn more, where's the, yeah, performance here is what I was looking for. If you look under performance, the daily prices, so every day you can see the prices here. Okay, so you can see the prices for May 25th here for all of them, closing prices. See, and this is the change. Okay, so your question about how much did it change? So the like this one, it was only 0.02 cents difference, 0.01, 0.12 in one day. See, very little difference, right? So this price is 3 cents, not 3 cents, 0.03 cents higher. It is 3 cents, right? Yeah, 3 cents higher than the previous day, right? So it's going to be very like little change in one day. Clear? Does that make sense? Sometimes it may go down also, it may go up. So the change per day is going to be very small. It may be more here. It's 34 cents here, right? So it varies day by day. Is that clear? So all of them you can see here, what is the daily price and all. And if you want to see previous days also, you can see, but usually it's a very little, like couple cents changes openly there. Clear? So that is the performance we were looking at here. You can see the daily prices, you can see, okay, so let's go back there. So that was about the, so we were talking about the equity fund, right? So next, let's talk about the balanced fund. So under the equity fund, we can see that, okay, let's go back to the fund overviews. Yes, under the equity funds, we have all these. Now, under equity funds, only invested in stocks. What if somebody says, I want a fund which has bonds in it and I want equities in it also? Then we have these called balanced funds. Let's take a look at the Canadian balanced fund.
Balanced fund has a mix of both, right?
That's right, perfect, yes. Equity and fixed income, okay? So it has both, yes. So let's take a look at this here, and we can see here that overall, this is again medium risk, and it is invested in stocks and bonds also. So you have a mixture here now, as you can see, 44% of your money is in Canadian shares, 36% is in fixed income, and so securities and US equity also. This also has a lot like $2,284 billion, $2.2 billion, a lot of money invested in this one also. 1.95 is the MER. And as you can see, the benchmark is different for this also, against which they will monitor. It is 45% in bond index, 45% is the Toronto Stock Exchange Index, and 10% S&P, because it has about 14% in US equity. So we can see it is invested in shares and bonds. So shares of Canadian Income, Royal Bank. Oh yeah, this income fund, this is the Canadian bond fund, which has bonds in it. So 37% of the money is actually invested in their own fixed income mutual fund. Okay, and the rest are the shares. So this fixed income is 36%. So that is mainly the fixed income portion. The rest are shares. Shares in Royal Bank, TD, Scotiabank, Power Corporation, Shaw, and other companies. So the breakdown of the fixed income, further, if you want to see, 64% are government, 23% are corporate bonds. And it is mainly in Canada with some investments in US. So 42 different types of stocks, 68 different types of bonds. If you have money, if you have $100,000, it's hard for you to decide which stock to buy, which bond to buy, and you know how to divide the money and which one is good, which one is bad, and you have to keep monitoring it. So the mutual fund provides a one-shot diversification. So remember we talked about yesterday, you mentioned one of the advantages of mutual fund is diversification. So by putting money in here, it automatically is distributed into all these types of investments, into stocks and bonds, automatically these types of investments. And so your return depends on the stocks. If Royal Bank shares go up, if TD shares go up, if a bond or value goes up and they give more interest, your investment will go up. And as we can see here, it has been overall okay. Some dips have been there. Overall, we can see the returns here, 1 year, 2 year, 3 year. So it usually is in the middle of equity and bonds. We saw in the bonds and we saw in the equity in 1 year, actually, the equity made 30%. And this has made in 1 year, it made 13.93%, right? So this is also the objective here for you to understand that usually the returns for the balanced fund will fall in between the two because they may go up and down. They may, because they equal out. You remember the bonds, we said they usually bond market and equity market, they work opposite. If stock market is going up, the bond market goes down and vice versa. So usually they go opposite and then you will equal out your returns. So again, no guarantees. It did go minus 3% in 2018. So there is again no guarantee in any mutual fund, right? So this is the investment, right? And these are again the portfolio managers. And yes, in each of them, yeah, here is the disclaimer. You see, you cannot give any of your own marketing material. You must give the marketing material with this printed stuff on it. This is very important mutual fund information. So it says here that there may be commission, trailing funds, management fees, expenses. Please read the prospectus. They're not guaranteed by CDIC. CDIC is Canadian Deposit Insurance Corporation. They cover up to $100,000, but that is they cover in the bank accounts and in also GACs, but not mutual funds. And this is very important. Their values change frequently and past performance may not be repeated. So basically no guarantee. It's written there, like clients should not be misguided that, oh, I'm going to get so much return, right? So this is obviously must be mentioned and indicated to the client, right? Clear? So everyone clear about the balance fund? Okay, let's talk about the global fund. So the global fund is working the same way. So there's actually two, okay, equity fund, here we go, yes. So just to make clear between the two, international equity and global equity. Anybody know the difference between the two? Who's read through these two types? What's the difference? They both seem like they're both international. Yes, anyone? Yes. Anyone? No? Okay, so international equity is going to be, of course, outside of Canada. If you go for a flight at Pearson, although no flights now, but if you do, international means you're going outside of Canada. International equity funds are only invested in companies which are outside of Canada. Okay. Global is including all of the world, so it includes Canada and other countries also. So that is the difference between global and international.
So international just international just for like international like countries and stuff, but then global it includes like Canada and US since they're not international.
That's right. Just like European. Europe is obviously outside of Canada, right? This has nothing to do with Canada. So if you look at the European fund, this is an international fund, right? And it is invested in European companies. And we don't know what these companies are. I don't know what is ASML and this, I don't know, these companies. You have to look on there and search their website. Hexagon, FTV, never heard these names. L'Oreal, we know, is the makeup company. But otherwise, these are all, you see, they're in France, in Germany, Netherlands, Switzerland, Sweden, none in Canada, right? So this is your international fund. It is highly risky, right? And as we can see, it can go up and down. It's also because their foreign currency exchange will change, and those companies, we don't know much about them. of course, Scotiabank, their portfolio manager have to do a lot of research on them, right? And as you can see here, although 1 year did pretty good, 39% actually, but 2 years, 5 year, 10 year, we look at long term, and as you can see, it could have gone down 6%, could have gone up also 13%. It went up 32% here, but as you can see, it's like a roller coaster in Wonderland, right? It's like behemoth. So that is going to be international type of mutual fund with all over the world, outside of Canada. 43 companies outside of Canada. So if somebody wants to invest in that, they have this option here. Instead of you having to pick and choose the companies, you can just put your money in this mutual fund and your investment will grow or fall depending on these companies. Clear? Right? So that was the global and the also, yes, global and international. Those are those ones. So let's look at the specialty ones and then we can take a break. The specialty ones are mainly in one type of investment. I'm going to show you the resource fund. This is the specialty one. It is
One type
only
meaning like one area?
Yes, one area. It is only invested in one type of company. So it is equities or companies in the resource sector. Only companies which are in mining and energy companies, they are going to be this one. So let's take a look at this one. This is the specialty fund example, natural resources equity. It is invested in companies in oil and gas, gold, precious metals, and forest companies. So it's a special niche type, right? Natural resource exposure. So as you can see the circle here, very high risk, okay? It's going to be very risky. And its MER is 2.06%. It's invested in NextGen, Great Bear Resources, gold company, copper, energy. Suncor is Petro-Canada, but still we don't know, like this is, we don't, energy sector can go up and down. Price of oil goes up and down. Gold prices go up and down, whatever. It can be affected a lot by it. It's mainly in Canada, Australia, US. And as we can see here again, the roller coaster. It can go up, it can go down, it can go up, it can go down. So as you can see, it will vary a lot. So the returns, 14, -14, plus 45%. So this is probably really good. But then 10%, -12, 18, 7, 2.6%, right? So it will vary a lot. It will. So if you're ready for value to go down suddenly or value to go up suddenly, then this is good for you. If you're not, then this is not right for you. Clear? Does that make sense? Okay, good. So I think let's take a 5-minute break and then we will continue. Is that okay?
Yeah, perfect.
8:02, yeah, 5-6 minutes break and we'll be back. Okay, see you guys soon. So as I mentioned, you should keep in mind that the riskier. Okay, so actually I'm going to stop recording.